Hey everybody, good morning. Hope you had a good Father's Day. Welcome to our Monday coaching call. Again, as usual, if there are things that you'd like to cover, things gone well, things gone poorly, success stories you want to share, or if you've got problems that we can work through, everybody will benefit from that. So please either let us know via, if you have a headset, you can talk to us, or if you called on the phone, or if you type in a question or comment, we'd be happy to address that. In the meantime, our topic today is about it's really been in the forefront of an investment news here the last month, which is bonds and what our options are with bonds. And Jeff's going to cover that because he does a fantastic job with the technical stuff like that. Before we get there, I just want to comment. Thank you so much again to all the people that were on the phone call here a couple of weeks ago about the new presentation for the WealthMax. Apparently that was a good presentation because we've had a ton of WealthMax written in the last week and a half. So guys, at a 9% commission, that's not a bad product to be selling in the summer when things are a little bit slow, and that presentation is killing. I mean, guys are just using the presentation at 70% because they don't even know it yet, and it's just closing business left or right. So if you have not looked at that presentation yet, please contact us here at support@5qgroup.com. And if you haven't gotten familiar with the WealthMax product, you need to do that immediately with your 5Q specialist. You're walking away from a ton of business right in the palm of your hand. So yeah, I was surprised how much has been written in the last week and a half. So if you haven't done that, thanks to all those that have done that, and I'm sure you're very happy. But the ones that haven't, make sure you contact us. So with that said, Jeff, you want to take over and talk to us about bonds?
Yeah, absolutely. Today, I really want to spend time talking as advisors, and then towards the end, we'll bring our clients and their perspective into the discussion. But primarily, I just want us to kind of understand the environment that we're in and the things that affect bond values and what we might be looking at going forward. So I usually like to start a discussion about bonds with the question, how have the markets done the past 5 years? And so what we're looking at, in case you're unfamiliar or in case you've never done this, you can go out to MSN and type in dates for practically any index or any market that you want to look at, and it'll pull up a chart for you. So this is just the beginning of 2008, January 1st, 2008, through the end of 2012, 12/31/2012. So the last 5 years. This is the S&P 500. And if you just looked at that, just generally, what would you say the S&P 500 has done? I mean, it started here January 1st, and by the end of 2012 we were right there. So not a whole lot. Didn't do bad, didn't do good, pretty much even. And if you look back, you find that that's pretty much what it did, down 0.04%. That's the S&P 500. But you know, when we talk about what markets we're looking at, or when we talk about how the market's done over the last 5 years, oftentimes it kind of depends on what market you're talking about. So that's the S&P 500, kind of a broad measure of U.S. stocks. But I know that a lot of you as advisors, again, we're talking as advisors, you know, might use money managers. So let's talk about some things that money managers might do, or some strategies that they might employ, especially in bad years. How about absolute return? How has the absolute return index done over the last 5 years? Well, down 3.72. What about hedge funds? I know a lot of people like hedge funds. So this is kind of the HFRI Global Hedge Index is kind of a broad measure of hedge funds. Down 8.89 over the last 5 years. How about emerging markets? I know that's popular. Down 18.87 over the last 5 years. How about bonds? Barclay Aggregate Bond, up 12.84. So not bad over the last 5 years. How about long U.S. Treasury? So bonds again, long U.S. Treasury, up 29.93 over the last 5 years. And then kind of a world index, MSCI All Cap World, down 13.33. So let me ask you this. Do any of those jump out at you? Anything that's better than all the others? And I think it's obvious that bonds have done tremendously well over the last 5 years. So here's the question. is the smart money on bonds these days? And to kind of answer that, we have to look at why bonds get valued the way they do. And there are really 4 things to consider when pricing bonds. We have to look at supply and demand. We have to look at interest rates. We have to look at inflation. And then we have to look at credit quality. So these 4 factors affect the value of bonds. And they can be either a headwind or they can be a tailwind. So what do I mean when I say that those 4 things can be a headwind or a tailwind? Well, by a tailwind, what I really mean is that they'll help bonds. They'll drive the prices of bonds up. There'll be a boost. That would be a tailwind. A headwind would be something that's an obstacle, something that's going to drive bond values down, something that's going to be a hurdle, something that they're going to have to overcome. So that would be a headwind. So a tailwind would help. A headwind would hurt. So let's just talk briefly. Let's look at those 4 things: supply and demand, interest rates, inflation, and credit quality. Let's just talk briefly about credit quality. I don't want to spend a lot of time on credit quality because it really doesn't affect all bonds. It only affects some. It only affects those that are issued by entities with bad credit. But credit quality is always a headwind. Bad credit never helps. Bad credit only hurts. It forces the issuer to either give higher interest rates, and it lowers the value of their bonds. So bad credit is always a headwind. And what we found, or what we've seen over the last several years, is that with interest rates being low at the banks and all the other places, that people are starting to take risk on junk bonds. That money put into bonds is meant for safe money, and that we as advisors only choose high-quality bonds.
Hey, Jeff.
We're only talking about...
I'm losing you every once in a while.
Okay. We're only talking about high-quality bonds. Can you guys hear me okay?
Yep, we can now. You're just breaking up every once in a while.
Okay. Let me make sure everything's
Can you
plugged
hear
in
me
here.
okay?
I can hear you fine. Okay, so...
Let's just have you switched into Mike's headset here real quick. Just use this one for a minute. Thanks.
Now, can you guys hear me okay? I can't hear myself.
Are you muted?
Now, can you guys hear me okay?
Yep, I can hear fine.
Okay. All right. So we're going to assume for the time being that we're not even going to touch poor credit quality bonds. We're not going to look at junk bonds. We're only going to talk about high quality, highly rated bonds for safety and for income purposes. So let's focus on the 3 things that can move all bond prices, even high quality bonds, either up or down. So the first thing we want to look at is inflation. Okay? Inflation can affect the value of bonds. And let me ask this. What has inflation been like the past 5 years? I don't think there's any argument that inflation has been extremely low. And that's good, because bond traders view inflation the same way Superman views kryptonite. Inflation erodes the value of a bond's fixed interest payments. And when traders think inflation is in the air, they bid bond prices down and yields up. And so I just want to show you a quick chart to give you an idea of why that happens. Let's say you had a $100 bond and it was paying 3% interest. So it's paying $3 in interest off that $100 bond. Okay? And let's say after 1 year we see some inflation. Let's say we see 3% inflation. So you're still getting $3 in interest payments, but that $3 only buys $2.91 worth of stuff because of inflation. Now, that $2.91 is the equivalent of 3% on $97. So guess what happens to the value of the bond? It falls. People say, well, this bond's not worth as much because it can't, that $3 doesn't buy as much. And traders bid the price down, and you can almost see, if you knew exactly what the rate of inflation was, you could almost pinpoint what the value of a bond is going to fall to. In the second year, that $291 only buys $2.82 worth of stuff, and so the value of the bond is bid down to $94.09. So the point is, inflation drives bond values down. Now, we haven't seen a lot of inflation. In fact, little to no inflation in the past 5 years, which is good for bonds. But what should we expect inflation to do going forward? Go up or go down? Now, I think we all know that inflation is probably as low as it's been historically, and that we probably shouldn't expect it to go any lower. That we should only think that it's going to go higher. But now some people, some advisors would argue that the Fed has made a commitment to keep interest rates low and keep inflation under control. And so, sure, inflation would negatively impact the value of bonds, and inflation's really low, but the Fed's going to keep it low. So we really don't have to worry about that, at least in the near future. Well, let me ask you this. Would it surprise you to learn that the Fed would actually like to see more inflation? This is a headline from Bloomberg Businessweek last week, or actually last month, May 1st, 2013. Why the Fed worries inflation is too low. See, the Fed actually would like to see more inflation than there is right now. See, they think inflation is actually good for growth, and here's their reasoning. They want to keep interest rates to below the rate of inflation to give homeowners and businesses a strong incentive to borrow and spend. They're going to put that money that they borrow and put it out into the economy, and we're going to be able to spend that money on goods and services, and that's going to help us. But it's really hard for the Fed to do when inflation is so low, because they can't make interest rates zero or less than zero. So when inflation is only 1%, it's really, really hard for them to keep the interest rates lower than 1%. They're finding that as time goes on, it's near impossible. We'll see that here in a second. So they actually want there to be more inflation. They'd actually like to see inflation more in that 2 to 3% range. And they also think that inflation eases our debt, that we're paying back dollars that are worth less than when we borrowed. So it would ease our debt. We've got a big debt problem in this country. So if the Fed wants more inflation, guys, what do you think we're going to see in the next couple years? If the Fed wants more inflation and they can manipulate the supply of money, guess what we're going to have in the next couple years? More inflation. And like we saw, more inflation is a serious headwind for bonds. That's going to be a huge hurdle that bonds are going to have to overcome. And the Fed's not going to help. In fact, they're actually going to hurt. They're going to drive inflation up if they can. So what about interest rates? Well, we've all been told that bond values move opposite of interest rates, that when interest rates are low, bond values move higher. But it always helps to explain, especially to clients, why that happens. Why does that happen? Why do bond values go lower when interest rates go higher? And we always like to tell a little story, and it's there in the disclosure software, and it's there in the disclosure meeting. And we just ask people, let's say you had a bond that paid 5%. And you wanted to sell it because you wanted to use the money to go on vacation or buy a car or whatever. You just wanted the money. So you put it up on the shelf for sale at the imaginary bond store. So down at the bank, the best that you can do for anything fixed interest like a CD is 3%. Well, if you're selling a bond for 5%, out on the street is 3%. Are you going to sell your bond for face value, or because there's a huge demand for it, what's going to happen to the price of the bond? Remember, when there's more demand than supply, there's fewer bonds paying 5%, there's fewer stuff paying 5%, and more people want it, the price goes up. So when interest rates are low, bond values are high. But let's say interest rates creep up, and now the best that they can do at the bank is 6%, and you've got something at the store, at the bond store, paying 5. Well, if they can get 6 somewhere else, and you have something for 5, are they going to want what you have? No, they're not, unless you're willing to sell it at a discount. So when interest rates go up, bond values go down. That's why that happens. Now, the million-dollar question is, well, how much do bond values go down when interest rates go up? Well, there's actually an easy formula for calculating that. We know that you have something, a $10,000 bond paying 5%, which is $500 per year. So I don't know if you can see my pointer. You got that 5% $10,000 bond, that's $500 per year. But if interest rates go up just 1 percentage point from 5 to 6, well, then they can get something at the bank that's going to pay $600 per year. So 6%. So the easy formula for figuring out what your bond is worth is just to take that that $500 dividend that you have, divide it by the new interest rate, 6%, and it tells you that your bond should be revalued at $8,333. In effect, what it's saying is, if I gave you $8,333, you'd give me back something that pays me 6%. Oops, sorry. You give me back something that pays me. You give me back something that pays me $500, which is 6% of $8,333. But look what happened. Interest rates only went up by 1%, but the value of the bond fell by 17%. And guys, that's what happens. It doesn't take a big fluctuation or movement in interest rates up for bond values to come way, way down. In the last 5 years, interest rates were a tailwind. So we can see why bond values did so well over the last 5 years. And if you had bonds during that time, you were really happy. But with interest rates so low, what should we expect going forward? I mean, we all know that interest rates eventually are going to creep up, especially with the Fed wanting more inflation. So interest rates are going to be a headwind. And we can we're at the beginning of that. We can kind of see what happens when interest rates creep up even a little bit. This is a quote from USA Today on June 11th, 2013, so just last week. And it says, you've probably heard it before, but for more than a month, you've gotten to see it in action. When interest rates rise, bond prices fall. Interest rates have indeed been rising since May 2nd, when the yield on the bellwether 10-year Treasury note hit 1.63%. The 10-year Treasury note yield will hit 2.19% Tuesday. Still low by historical standards, but a sharp rise nonetheless. The 25 largest bond ETFs, bond funds that trade on the stock exchanges, fell an average 3.2% since May 2nd, according to Capital IQ. That figure includes reinvested dividends. So guys, look what happened. Interest rates went up from 1.63 to 2.19. That's about a 60 basis point rise in interest rates. And yet, in spite of the fact that they only went up 60 basis points, bond ETFs fell 3.2% in a month. Not over the course of a year. They fell 3.2% in a month. So they're headed for a huge fall. We've got inflation about to go up with the Fed's blessing. We've got interest rates already moving up with the Fed's blessing. And we're seeing that that's a huge headwind or a huge hurdle that drives bond values down. The last thing I want to look at, though, is supply and demand, because this is the thing that usually people know that credit quality affects the value of bonds. People usually know that interest rates affect the credit, or interest rates affect the value of bonds. And it's not as well known, but at least among advisor circles, maybe not the general public, but we as advisors it's obvious to us that inflation also drives the value of bonds down. But what a big, huge factor in the price of bonds that consumers overlook, and a lot of times even we as advisors overlook, is supply and demand. So the general economic principle that we can all agree on is over-demand is good for prices. So if more people want something than there is that thing, the price is going to go up. Oversupply is bad for prices. If there's more of that stuff than people that want it, the price is going to come down. So over-demand is good, oversupply is bad. Okay, so QE1, QE2, and QE3. They aren't cruise ships. So what are they? Well, they're the Fed strategy over the last several years to buy $800 billion in bonds and replace them with $800 billion in cash to jumpstart the economy. So even in this low interest rate environment, when you have the Fed buying hundreds of billions of dollars worth of bonds, that creates an over-demand. And if you owned bonds during that time, you were happy because that over-demand drove up prices. Now, some critics said, well, these policies will result in some serious inflation down the road. And the Fed's response to those critics was, well, don't worry, we plan to sell all those bonds back. And when we buy them, when we sell them all back, we'll mop up all that extra cash through the sale of those bonds. But notice when they bought $800 billion worth of bonds, that created an over-demand. That's good for bond prices. But when they sell $800 billion worth of bonds back into the economy, that's going to create an oversupply. That's bad for bond prices. And even speculation, even the idea, even loose talk that the Fed will begin to scale down their purchases. We're not even talking about selling the bonds. Just buying fewer of them over the next several months actually rocks the bond world. So from their last meeting, May 22nd, Fed Chairman Ben Bernanke said during a response to questions following congressional testimony that the central bank could consider reducing the amount of treasuries and mortgage debt it buys within the next few meetings if officials see signs of sustained improvement in the labor market. So he said on May 22nd, maybe we can scale back our bond purchases. Maybe we don't have to buy as many as fast as we've been buying them over the past couple of years. So him saying that, look what happened. Bonds dropped globally as stocks reach highs on growth optimism. Global bond markets posted their biggest monthly losses in 9 years in May as the U.S. dollar rallied and stocks reached record highs amid speculation a strengthening U.S. economy will allow the Federal Reserve to reduce its monetary stimulus. So as soon as they said, hey, we may pull back a little bit, not end it, not sell those bonds, just pull back, and global bond markets take a huge, huge hit. So they know what we ought to know but often don't realize is that they're not going to be driving the prices of bonds up for very much longer. And when they stop propping bond values up, they're going to come crashing down. Why will they come crashing down? Well, because there's not that demand anymore. Inflation is high. Inflation will be higher. Interest rates will be higher. And eventually, once the Fed stops propping it up, the next step is for them to start creating that oversupply, and it's all going to come crashing down. See, when it comes to interest rates rising, when it comes to inflation going up, when it comes to the Fed pulling out of the game of manipulating demand for bonds, there's a glaring storm ahead for bond prices. And the thing that we need to be aware of is it's not a question of if, but when. See, economists aren't saying, well, if inflation goes up, or if interest rates go up, or if the Fed ever sells back their bonds. They're saying when inflation goes up, because it's going to go up. And when interest rates rise, because they're going to rise. And when the Fed eventually stops buying bonds and actually starts selling them back, because that's going to happen eventually. We just don't know exactly the timing of it. It could be next month. We started to see inflation and interest rates go up. The Fed's talking about doing less propping, not necessarily selling, but doing less propping, and we've seen that that just absolutely rocks the bond world. That scares the heck out of them. When those things happen, it's going to be bad. And so no one knows for sure when they'll happen, and we don't know exactly the order in which they'll happen. But again, the conversation isn't if, but when. And if that's the conversation, what should you do? I mean, should you wait for that to happen to get your clients out of bonds? Should you wait for that to happen before you stop putting money into the bonds? I mean, your clients need to be aware that this is going to happen, and even if it doesn't happen next month or next year, it's going to happen. And when it happens, there won't be time for anybody to pull out. And when the Fed decides that they're done propping up the prices and they're going to start selling those bonds, at $800 billion worth, there's no way anybody could get out fast enough not to take a huge hit. So the question is, should you be creating bond positions or adding to them right now, knowing that bond values are about to go over a cliff? Here's what Warren Buffett says. This is from May 6th of this year. He says he doesn't like owning bonds right now, and he doesn't think the average investor should either. The CEO and chairman of investment conglomerate Berkshire Hathaway says individual investors should keep enough cash on hand to be comfortable if the unexpected happens. So let me ask you this. What does cash pay, guys? Virtually nothing, right? And Warren Buffett's saying, you're better off holding cash than bonds. I'd rather see you hold cash that pays practically zero than any kind of bond. Anything that's not in cash should be invested in stocks, he added, even though stock prices are well above the rock bottom levels they hit several years ago during the Great Recession. Buffett said on CNBC Financial News Network Monday, this is Monday, so that would have been May, I don't know, the first part of May, but not that long ago. Bonds are a terrible investment at the moment, and that owners of long-term bonds may see big losses when interest rates eventually rise. And that's a guy that a lot of your clients have heard of and trust and know. And if you're recommending bonds in this environment, it's not going to take much for them to figure out that a lot of people, I mean a lot, all economists, all institutional investors are saying bad, bad move. Really bad move. So what's the alternative? I mean, people look to bonds because of the safety and the possible income. So as advisors, we need to look across the landscape and ask ourselves, well, aside from bonds, is there anything out there that can't go down in value that's safe, but still has some potential for growth because, again, cash isn't paying a whole lot. So is there any product out there that we have that can't go down in value and still offers the potential for growth? And if people want income from their bonds, is there something out there that's safe, has the potential for growth, and can also offer income? And guys, we're in that business. We're in the business of showing people that as an alternative, there are income rider products that are out there that have a guaranteed roll-up rate of 6%. We even talked about one last month that has an 8.45% compounded annual roll-up rate. Can't lose value. Have the potential for growth. We've talked about the Wealth Max bonus, and we've shown you exactly how to present it. Again, something that's safe, something that has an 8% cap, for the potential for growth, something that can't go down. And so let me ask you this. Why isn't their current advisor, or why isn't the person that they work with giving them that option? And the answer is because maybe they make more money with bonds. I mean, if you've ever looked at our disclosure meeting, that's the exact conversation that we have with clients. We go through all the problems that we're going to see going forward, and then we ask, why do you suppose he hasn't shown you this? I mean, why do you suppose the only thing he's ever showed you or talked about is bonds? Maybe it's because he doesn't know that there are better alternatives out there. Maybe he doesn't care. Maybe he doesn't want you to know, because if you go to Wall Street and you see somebody with those $900 shoes and that $5,000 suit, that's not a stockbroker. That's a bond trader. They make more money on bonds than on stocks. So I don't know why he didn't show it, but isn't it interesting that he doesn't show you the alternatives and does show you the one thing that pays him a lot of money. So, guys, don't let that be you. Because if you're putting people into bonds and you're not showing them the alternative and giving them the choice, then if somebody else shows them the alternative and gives them the choice and talks about the problems with bonds going forward, and they go home and Google it and find out that it's true, you're toast. They're not just going to move their bonds away from you. They're going to move the whole account. So we have an alternative, and we have to be mindful that these things are coming down the road and they're not looking good for bonds. In fact, some would argue that the boulder's already started rolling downhill. And once it gathers enough momentum, there's no way to get out and there's no way to stop it. Any questions? That's really all I have.
That was awesome, Jeff.
Questions, anybody?
There's no questions that are coming in. Oh, here's one. Thanks for the insight. How do bonds compare to the IRR of a whole life policy?
You know, you're going to have to ask your 5Q specialist, because the internal rates of return on a whole life policy and those illustrations, I'm not good at reading them. I'm not good at calculating them, but there are people that do. But I'm pretty sure that the whole life policy, the whole life policies, at least the ones that we've talked about, well, I don't really even know whole life as well as I do indexed universal life. But
well, can I jump in there?
Yeah, go ahead. That they can't go down the way that bonds can go down.
Yeah, the internal rate of return of a whole life as compared to bonds over the last 10 years has been not very good, because bonds have had a tear. But the way that insurance companies manage their portfolios, they hold huge amounts of bonds, and they buy huge amounts of bonds on a weekly basis. So the internal rate of return is always going to be muted or delayed. It's never going to be as high as bonds, and it's never going to be as low as bonds. It's going to be more right in the middle. And isn't that what our clients want? They want that middle. They're not looking for the highest because they never want to see the lowest. So the internal rate of return is never going to be as high, never going to be as low. And right now, so the last 10 years, it's not been as high as bonds. But I tell you what, going forward the next 10 years, it's not going to be as low as bonds either.
Yeah, and that's a great point. When we looked at the last few years, of course, bonds had all these tailwinds. They had inflation going down working for them. They had interest rates going down working for them. They had the Fed buying $800 billion worth of bonds working for it. But all those things that were working for it are now working against it. I mean, we saw the Fed says, well, we want more inflation. And we saw that interest rates are already creeping up. And we saw what it did to the value of bonds. And we heard the Fed say, hey, we're not going to be buying them as fast going forward if the economy continues to improve. And we saw what that's done to the economy. So all those things the Fed is saying that's going to happen. Inflation's going to go up if we have any say about it. Interest rates are going to go up too. And we are not going to be buying bonds at this breakneck pace.
Here's a question that we always get from somebody who is a securities-oriented and doesn't get it. And that is that, well, isn't insurance companies, aren't they bonds? So what's the difference between bonds and insurance companies? You might as well buy bonds. And that's somebody who loves to sell bonds. Why? Because, again, bonds are very profitable. I used to sell bonds, guys. Bonds made me a hell of a lot more money than mutual funds made me. Bonds made me astronomically more than stocks made me. Bonds made me a ton of money as a salesperson. So I get why people want to sell bonds, but it's not right for the client. So why are bonds in an insurance company better than bonds outside the insurance company? Because they're insulated. Can you sell bonds inside of an insurance company? No. You own the policy. You get whatever they say. So they don't do dumbass things inside of a insurance company. They hold the bonds. They hold the bonds until maturity. If you hold a bond to maturity, it's not risky. But if it's outside of annuity, guess what people do with their bonds when interest rates start going down? They sell them. So if I have one place where you can't sell a bond and it's getting good interest, it doesn't matter whether the value is going up or not. They bought into the interest base. It's like a ladder. They bought in for the interest, not for the principal. But outside, you have no choice. Your bonds are going down in value. And I don't care. Guys, when your client gets their statement and their bonds have dropped by 20%, and I have lived through that. I have seen that. I have seen AAA bonds drop 20% in value. When they get that statement and you go and they want to know why the hell you just sold them these safe things, these guaranteed things, these AAA things you told them that went down 20%, and then you try to explain to them that, oh, no, it really didn't go down. I mean, you still have the interest coming in, don't you? You still go, good luck. But do they ever see their annuity going down 20% in value? I'm sorry, Jeff.
Yeah, Mike made a great point. There's two problems with that theory of, hey, if insurance companies are buying bonds, what's the difference between me putting my client in bonds and the insurance company putting their client in bonds? And there's really two problems with that. Number one, you can't buy bonds the way an insurance company buys bonds. They buy millions of dollars of bonds in a day. So you can't buy a lot, $1 million lot, but an insurance company can. You have to buy a partial lot. You have to buy a lot that's been divided and cut and sliced and divided amongst all the advisors around the country, and because of that, you don't get the volume discount that the insurance company gets. By sheer economy of scale, they get a better deal than you could ever get, a much better deal. And because the insurance companies...
On that, and maybe you're going to make this point, who do you think is better at buying bonds? The bond buyers at an insurance company or you?
And the insurance company, like Mike said, can hold them for 30 years. So they get the better rates. They can hold them. They just hold them to maturity. You're insulated. So you can't buy bonds the way an insurance company buys bonds. But here's the other point, and this is really the key. When you buy bonds and you put your clients in bonds, you have what's called investment statement risk. And that's exactly what Mike alluded to. You told your client that we're going to put your growth money in things that could go up but maybe could go down, but if you hold them for the long term, you might be okay or should be okay. But your safe money we'll put into bonds. So what do you think a client thinks when they see their growth money go down, which they knew that could happen, but they look at their statement and see their safe money going down, which they thought their safe money meant safe. And when they see both parts of their portfolio going down, you've lost a client. I've seen it with advisors many, many times. They look at their statement and they say, all my money's going down. I thought you had us in some safe things. And
guys, I have lived through it. As an advisor, I have lived through trying to explain to clients. Now, not in the last 10 years, because, guys, you've had the, like Jeff said, you've had the wind at your sails. Bonds have done nothing but go up. But I have lived through, in the last 25 years, a horrible time when I had my clients in bonds, AAA bonds, government bonds, and I had to explain to them why their accounts went down 20%, 25% with guaranteed things. And you can talk to your blue in the face, well, if you hold these on till your maturity, they're not having it. They are not having it, and they will sue your ass. Because you told them this was safe stuff, and it's going down. And you cannot say they are safe if you hold maturity. Good luck with that explanation, guys. Because can you do that with stocks? Sure, you can, because they know stocks are risky. As soon as you say, hey, we just have to hold on until they recover, they'll buy that because they know stocks are risky. But you sold bonds as safe. So when you say, hey, we got to hold on to maturity, they'll tell you, you never told me that. You said these were safe. and I'm looking at my value of my bonds, and they're down 20%. I'm talking to my attorney. So good luck for all you guys that are protecting your bond portfolios because you think that they're okay. Dudes, bonds will kill you. They've been terrific the last 10 years. Yeah, but guys, that ride is over. And if you don't understand that, you better sure in the hell not have your clients in bonds because you are dangerous to your clients if you don't get that.
And really, you're banking on you're banking on two things. You're banking on one, that won't sound offensive, and that they'll buy that and hang with you through the storm that's coming. You're hoping that. And number two, and maybe more importantly, you're hoping like heck that nobody shows them an alternative. Because if somebody shows them a product that can't go down, has the opportunity to go up, actually benefits from the environment that we're heading in, has an 8% cap, the likelihood that they're going to stay with you and not choose the alternative is really low.
And that's if you're lucky. I would much rather have them move the money than sue me because I told them something was safe and it wasn't. Guys, do they ever get, with your annuity statements, do they ever get a statement showing that their account is 20% down? I've never seen an annuity statement that does that. So even though they held bonds, they didn't see their account values go down because they didn't. Because the insurance companies have bought the bonds. They manage the portfolios to hold for long periods of time. So they don't report that the accounts have gone down. But if your clients are holding bonds in a managed money account, if they're holding bonds in a brokerage account, they will see their accounts go down. This guaranteed account, this safe account, go down. That's not what they're looking for. And I want you to understand this. Every research that I've looked at for the last 5 years, even the last 5 months, I've seen 2 more research reports. Guess what people want? Are they looking for high returns? Even though we've seen the last 3 years we've had a bull, 3 bull markets, still are they looking for high returns? No. They are looking for safety. They are looking to preserve their principal. Who's pushing the high returns? Brokers are, advisors are. For some reason, advisors and brokers are not listening to their clients. Their clients are not pushing for high returns. The clients are pushing for safety. And right now, for the last 10 years, bonds have been safe and high returns. What we're trying to tell you is that ride is over. That ride is over. Go look at the history of bonds. You're going to see that they're cyclical. And Jeff's explained extremely well why they're cyclical. And all the headwinds are gone. They're ending. They're stopping. Bonds cannot continue to do what they're doing. There's only one direction for them to go, and that's down. But you will not be hurt in an insurance company bond portfolio because of the way they buy bonds. They buy bonds in a completely different way than how investors buy bonds. Their goals are different. The outcome is different. Yeah, go ahead.
And again, be mindful. I mean, we're talking as advisors. These are the things that we watched, but maybe the consumer doesn't watch. The Fed is saying these things are going to happen. You know, I hear a lot of advisors say, well, no, the Fed's not going to let that happen. Guys, the Fed has said this is going to happen with our blessing. We want more inflation. If the Fed wants more inflation, guess what we're going to have? More inflation. The Fed says we're not going to buy bonds any longer at this breakneck pace. If the Fed says they're not going to buy bonds any longer at this breakneck pace, guess what's not going to happen going forward? They're not going to buy bonds at this breakneck pace. If we're hoping that the Fed is somehow going to turn the tide and stop this from happening, you need to look at the headlines. The Fed is saying we're going to help this along. We need more inflation. We're going to have more inflation. We can't buy bonds like this anymore. We're not going to do it. They're signaling that that's what's going to happen.
Well,
if you're a Fed watcher, you know that this is going to happen.
Well, and here's what's hilarious, Jeff. They're telling us what's going to happen, and you still have idiot advisors out there talking to their clients about bonds. I mean, they're telling us what's going to happen to bonds. And you still have people out there recommending their clients buy bonds. It's crazy. I don't get it. I mean, it'd be different if the Fed was doing this behind closed doors secretly and then popped this on it. They're telegraphing in headlines what they're going to do. It's crazy. Guys, please pay attention. You're going to get crushed if you're still promoting bonds and if you're not moving your clients out of bonds. And there are fantastic solutions for your client's safe money outside the bonds. And we've been talking about them the last 2 months. So anything else to add there, Jeff? Any more questions, Missy?
No.
There are a couple more questions/comments that have come in. With the inverse relationship of bonds to stocks, and I would guess that stocks will continue to rise. The question is about the slow economy with the inflated stock market and the $17 trillion of debt to pay off. What's going to happen to bonds? What will happen to bonds? Come back in value? What's the argument for selling FIAs to protect people's nest eggs instead?
You don't have to have an argument to sell FIAs to protect the nest egg instead. Why don't you just use the presentation that I did a week and a half ago and then ask the clients what they want to do, and guess what they're going to tell you they want to do. Guys, I've had advisors, and we've asked advisors thousands of times from back in the early or late 90s when the stock market was making 33% a year. And we've talked to clients when the market was going down. And I don't care when the market's going up 33% or the market's going down 33%. When you ask clients, hey, if I gave you the choice between a 10% rate of return and an 8, which one do you want? They'd all say 8. Now, caveat, the 10% can next year make 10, 20, or lose 10 or 20. And the 8, you can never lose that. I have never heard once, and Jeff, you've been doing this with as long as I have with me, how many of our advisors have ever heard any client say anything but, I'll take the 8 where you can't lose money?
Yeah, I've never heard that.
Guys, read there was a Nobel Prize winning psychologist for economic psychology. People are much more afraid of loss than they are looking for gain. People are 10 times more afraid of loss than they are affected in a positive way by gain. They are afraid of loss. Nobody has ever said they'd rather have a 10% rate of return that they could either lose or make next year, another 10, or lose 10 or make 10 the next year. Nobody's ever chosen that. Make 20, lose 20 the next year. Nobody's ever taken that other than an 8 where you can't lose money the next year. And for saying, I'm assuming stocks will go up, that's a dumb assumption. Guys, what's the stock market going to do tomorrow? What's it going to do next week? What's it going to do next year? Anybody who's assuming the stock market's going to go up is a complete blithering idiot. Because what can the stock market do? I assume that it's either going to go up or go down. That's what I assume. Because to assume anything else, again, you had better not be making those assumptions with clients because you are a danger to your clients.
Yeah, you're making two assumptions that may or may not end up being true. One, you're making the assumption that the stock market's going to continue to rise, that we're going to go beyond 15,000 to 16 and even 17,000. I don't think that's an assumption that I would hang my hat on. And two, you're also making the assumption that stock prices and bond prices actually work inwards of each other. And that's not necessarily true. You can have stocks down and bonds down all at the same time. But the other thing that I would say is give your client choice. I mean, when you start looking around, and if you ask clients, you know, we need to have some money for growth, so here's my proposal for growth. But now we need something safe, so let's talk about what's out there for safe. We could put it in the bank, but what's the problem with the bank? Because the bank's safe.
No money.
Not make anything. Yep. No, it doesn't pay anything.
Right.
Now we could put it in bonds, but here's the problem with bonds. What do we think interest rates are going to do?
Go up.
We think they're going to go up. And what does that mean for bonds? They're going to go down. What do we think inflation's going to do? It may go up. Yeah, what does that mean for bonds? It means they're going to go down. What do we think the Fed is going to do? Well, we think they're going to sell those back. What does that mean for bonds? They're going to go down. So those are our two options, but there is a third option. Would you like to hear it? Yeah, I mean, what's the problem with the bank? Doesn't pay a lot of money. What's the problem with bonds? Well, in this environment, could go down. Would you like to see a third option? Sure. Well, what if I had two investments? One that paid 10 and the other paid 8. Which would you want? I'd want the 10. Why? Because it's more. Well, let me throw in a little catch. Well, let's say there was a catch. Would you want to know what the catch is? Yeah, I'd want to know what the guys were right into that. And what do you think they pick every time? between the bank bonds and this, what do you think they pick every time? Give them the choice. See for yourself.
Now, don't believe me. Don't believe Jeff. Do the presentation, and you'll find out that 100% of the time those people, I'm not kidding you, 100% of the time they're going to choose the 8 that can't go down. I mean, and that is, Jeff, have we used that same presentation when the markets were going up 33% a year?
Yep, absolutely.
And have we used that when the markets were going down?
Yep, absolutely.
And do they ever choose the 10 that could go up 20% next year or down 20% next year, or the 8 that once you have it, you can never take it away?
They never do.
Guys,
they always choose the 8.
When they want safety, they want safety. Go ahead and have your clients in portfolios with growth. But the safe money needs to be safe. And our whole point of this last hour was bonds were safe. They're not anymore. So get out. So thanks. And again, guys, I get excited about this because that's we need to get excited about this. We need to have passion about our clients' portfolios. We need to be doing the right thing for our clients. And bonds right now are not the right things to do for clients. They want guaranteed money. You get them into guaranteed money. The bank, yes. Annuities, yes. Bonds, no. And we gave you a presentation a week and a half ago that if you give clients that presentation for their safe money, you're going to get all of their money in something that's going to make them happy if the markets go up, if the markets go down, if they lose a spouse and the check to Social Security, if they have a medical situation, or if at their death, and you're going to be happy too because you make a 9% commission up front, and when they lose a spouse, their money doubles, and they're going to come to who and ask, who are they going to come to ask to what to do with that money that is doubled? So the client makes out, and you make out. But don't believe us. Just do what is wrong with going to your clients with that presentation? Nothing. The only good things can happen from that. Have they ever heard of this or seen this presentation before? No. So they're going to be happy whether you think they're going to do it or not. Even if they don't do it, they're going to be happy. But if you do it, I'm telling you, we've sold a boatload in the last week and a half with that presentation. And these are guys that only did the presentation half-assed because they hadn't been able to memorize it yet. So if you're looking for that presentation, it is on the 5Q website under the selling meeting, under the implementation. So if you go to the closing on the left-hand side of the and look at closing, then the implementation meeting, if you look at the selling presentation, there's the presentation for you, the presentation for the product, the presentation for the how to deal with the taxes if they move their money, and the presentation of how you bring up the actual product. And guys, that's a guaranteed product. That's a product that the clients are not going to get a statement saying that their account went down. The only thing they're going to see in that statement is their account went up. That's what they want to see on their safe money. Go ahead and put their growth money wherever you want to put it. But do not put their safe money in bonds. Put it in annuities or in the bank. So, again, I hope those of you who know me long enough know that I get passionate about this stuff. And those of you who don't, well, now you know I get passionate about this kind of stuff. So Jeff did a fantastic job on bonds and the condition we're in right now with facts, figures, quotes, headlines, data, illustrations. That's what's going to happen to bonds. So thank you, Jeff. But the whole purpose of this was, guys, safe money does not belong in bonds right now. It belongs in annuities. And we gave you a great presentation to let your clients make that decision, not you. So I appreciate everybody on the call today. And presentation under closing invitation and what title? Oh, it's under, if you go to the website, I wonder if, Jeff, can you quick go to the website?
Yeah. Let me see if I can.
So while he's doing that, you go to the website on the left-hand side. Is the top of that closing, Missy?
It's closing category, and then it's implementation meeting.
Yep.
And then it is selling presentation underneath the part 2.
So can you guys see the website as I'm putting it out?
Yep, we sure can.
Take just 1 second here, guys, and you'll see it. So there's closing, implementation meeting, And then we have
Selling
selling
presentation.
presentation, yellow pad. There it is.
It's a pretty big video, so it just takes a minute to open.
And it'll walk you right through the whole presentation. So with that said, guys, appreciate you being on the call today. Jeff, wonderful job on that. And we'll keep this on the coaching website so that you guys can go back and look at it. There's a lot of great information there about bonds and how they work. So thanks again, Jeff. Thank you, everybody, for being on the call. And we will talk to you next Monday. Thanks, everybody.